Hello there, folks. Welcome into this four-piece here today. Four videos for me to react to. First one up here, I want to go over CPI numbers, react to that, kind of give my opinions and perspectives in regards to that. Obviously, it was CPI day here today. Then we're going to get into this one. We're still calling for S&P 500 to be back at all-time highs by mid-2024. So that's basically within the next 9 months, all-time highs. I want to react to this one here. Market sees something ugly coming. So I don't know. That's an interesting one. I want to hear, are they talking about the U.S. markets, international markets? What are we talking about there? And then last video I want to react to, this is for all Amazon shareholders out there, like myself. AWS CEO went on CNBC just an hour ago or so and was talking about kind of what's going on with their business model and whatnot from their brand new second headquarters in Virginia. So appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed to the channel. Also, if you ever want to say hello to me or you enjoy the channel or whatnot, follow me on Instagram. That'll be pinned comment down there. Send me a DM. Say hello to me. And yeah, I get back to people every day on there. So appreciate y'all. Let's get into this.
CME in Chicago, Rick.
Yes, and it's dropping as if somebody thought they had the number, but they're wrong because it's hotter than expected. CPI for the month of September headline expected up 0.3. And many are saying if you extrapolate this number, we're in the twos. Well, it's up 0.4%, up 0.4%. Still don't see a revision to up 0.6 in the rearview mirror because, of course, up 0.6 was the highest since June of 22. Strip out the all-important food and energy, which is what I was referring to with that extrapolation. It hovers at up 0.3%. That is the second month in a row it's been there. We haven't had a revision yet. The prior 2 months were the lowest since February 21. We had back-to-back up 0.2, but it's now up 0.3. And year-over-year, 3.7. Year-over-year headline, 1/10 hotter than expected, exactly as in the rear-view mirror. So that's 3.7 back-to-back. The recent low water mark there was 3%. That was in June. That was the lowest since March of 21. Now, this is my favorite year-over-year core, which, by the way, hasn't been below 4% since May of 2021, is now 4.1%, exactly as expected. However, we have made progress. It moves from 4.3 to 4.1. As I said, still haven't been under 4 since May of 2021, but 4.1% on its own is the lowest level since September of 21, when we were at 4%. Now, let's go to initial jobless claims.
Now, you know, what do I think about this CPI number and everything here across the board? Do I think this was good or do I think this was bad? I thought this was a little bit of a mixed bag. Obviously, coming in a little hotter than expectations are never good. It's a clear trend that, you know, obviously we have deceleration in inflation. We certainly are not quite falling off a cliff in terms of the rate of increase, right? Which some people might like, but you know, if you're falling off a cliff in terms of rate of inflation, then you could be looking at deflation, which means you're likely in a massive recession, right? So this is where you get in this interesting time period where you want inflation to continue to come down and not, you know, be almost like a non-factor in 2024, but you don't want it to fall so much that next thing you know, you're talking about deflation, because deflation is usually recessionary, right? And we actually had deflation in the great financial crisis, for instance, right? I think we actually had a lot more deflation in the great financial crisis than actually the numbers showed. My personal opinion, just common sense. But nonetheless, you know, yeah, usually if you're seeing deflation, it's very, very, it means you're in a bad economic situation.
It up 210,000. Darn close, 209,000, and last month revised up 2,000 to 209,000. Back-to-back 209,000. Let's look at it this way. We haven't been at 250,000 since the first week in August, just to put a face on it. And continuing claims, always a month in arrears, actually popped the handle. Expecting 1,675,000, it barely popped up above 1.7. 1,702,000, and in rearview mirror, a subtle upward revision from 1,664,000 to 1,672,000. We haven't been above 1.7 million since the second week of August, when we were 1,719,000. Suffice it to say that interest rates have moved up a bit. If you were to look at a two-day chart, what you'd find is that today we are looking at two-year note futures above yesterday's high yields, never dabbled below. 10-year, on the other hand, are aiming for yesterday's highs, but still haven't come to it, but have done some work under yesterday's lows. So should we start to trade above yesterday's highs, we could call this an outside day. Technically significant. I would pay attention to that dynamic. Becky, back to you.
All right, Rick, thank you very much. Again, we're watching that jump right now in yields and a little bit of pressure on what we've seen with the futures. Stock futures have given up some of their gains, but you're still talking about them all in positive territory. Steve Leisman joins us again right now with more on what he's seeing on this. Steve, what do you think?
I'm looking over it. I mean, obviously you had a pop in gasoline prices, up 1.5%, maybe a bit less than had been expected, but still, that's a big number to the upside. I'm looking at used cars falling 2.5%, apparel falling 0.8%. Looks like there was a bit of a surprise in shelter. I just want to scroll down here and see if I can find the owner's equivalent rent. That was 0.6. Yeah, it ticked back up, which is kind of contrary to expectations. On the other hand, we did have a decline in medical services. We're down 0.3%, or sorry, up 0.3%. On that, and also.
Okay, so, whenever you hear like, oh, this thing went up this month or that thing, it's very important. We don't put too much credit into that. You need to see a trend there. If you're, like you mentioned about rent ticked up there, right? I'm not so convinced rents are going to keep going up, at least at the rate they had been going up or anywhere even remotely close to that, okay? As somebody that has 2 rental properties, I can just tell you the rental market is much tougher than I think, a lot of people are kind of talking about or whatnot, right? And I don't see it really changing from that anytime soon. I think the rental market's going to continue to be in a challenge place in terms of being able to get those huge rent increases that you were able to get a year ago or 2 years ago. It's just not that market anymore. Home prices aren't going up like that anymore, right? Home prices in many markets, from what I see in reality, and I know the numbers can show one thing, I look at what I see in real life, okay? I saw inflation going up substantially in real life in 2021 before anybody was talking about it. I see the rental market being very challenged. I see the housing market being extremely challenged in real life based upon like people that I actually talk to, based upon like properties I own, based upon, all these things. Like, 2021, I was feeling inflation and I heard so much about inflation because I know so many people that run small businesses and they were all talking about it and what they were having to do with pricing and going up on customers and these surcharges and all this stuff. And, it just wasn't even like talked about. It wasn't until the very end of 2021, people started to talk more about inflation and, oh man, is this thing transitory or not? And then by the time we got to the first few months of certainly 2022, it was game over, right? Everybody was convinced of inflation. So I don't know, man. Let's just put it this way. I'm not very worried about inflation for 2024 at all. I'll just leave it there.
Transportation services were up 0.7 with a 4.9% increase in airline fares. That may also be passing along higher fuel costs into the ticket price there. I think this is the kind of thing that tests the market's mettle for figuring out, is the Fed really done here? I think it is, and I think there is some tolerance for this kind of oscillation in the number, a bit of higher on the headline, but right in line on the year over year when it comes to services. And while I'm talking here, guys, I just want to see the Fed probabilities, if they have changed at all. And they did a little bit for December. They remain below 10% for November, and they're up slightly above 30, call it 33%. They were down below 30% before we went into the number here for December. I still think the Fed is on hold here. I think there's some tolerance. But again, as I said, the data has to behave. We have to be in this situation where the Fed can be confident that inflation is gradually coming down. But so far, what I've heard from Fed officials, the burden of proof is on hiking again, not on holding.
Yeah, so I think the Fed will be very, very confident they've done enough, in 2024, right? Alrighty, next one up here. We're still calling for S&P 500 all-time highs by mid-2024.
Who is global investment strategist at JP Morgan Global Wealth Management. Welcome to both of you. Andrew, why don't we just start with what the FOMC minutes showed us yesterday? Yeah, one more hike most of them thought was necessary, but since then we've watched yields pick up pretty rapidly, and a lot of Fed officials who have said maybe the markets did their work for them.
It's really interesting because this was only 3 weeks ago that we had Fed officials meeting. 12 out of 19 thought they should hike another 25 basis points in this cycle. But now we have the minutes. Now we've heard from Fed officials. That move in Treasury yields really concerned them. It seems like that's really changed the tone that we've heard out of the FOMC. And I think they're probably not going to proceed with that hike. So we got strong jobs report. I think we're going to get a pretty, slower but still hot inflation reading this morning. But that move in 10-year yields, I think that's what's behind it.
So on pause, just to wait and see what happens, even if the CPI is hotter than expected, just like PPI was?
If we have a big surprise on CPI, maybe they could come back and hike in November. Remember, it's not until November 1st, so there's still time. Chair Powell's going to speak again before the meeting, so if they want to put some probability back in the market for that meeting. And then there's December. They could still hike in December. So it's possible they come back and hike, but it really seems like the bar to a further hike is just a lot higher now after that move in yields.
And at least that might explain why you have clients who are feeling a little more confident about jumping into equity markets, too.
I think so. And last week, after, the equity drawdown that we saw, it seemed people were more willing to get involved given valuations pulled back a little bit as interest rates had risen. And generally speaking, we're still calling for the S&P 500 to be back at all-time highs by the middle of next year. So encouraging folks to work that muscle again and start adding exposure to equities.
Yeah, I think one of the things that's exciting folks to maybe get back in the market, right, is past like the Fed and raising rates and fighting the Fed and all those sorts of things, right? Which, it seems like you might not be fighting the Fed anymore finally if the Fed's going to stop raising, right? Which they haven't announced, but it's looking more and more probable like that. But I think what's exciting, a lot of people maybe that were on the sideline and get back engaged in the market is look at how many brand name dividend companies are down huge, right? And we're talking, these are some of the most famous stocks in the stock market that people love to invest in, regardless of recessions, good economies, bad economies, okay economies. It doesn't matter. Those type of companies always put up their numbers, right? And you look at the fall of so many of those stocks, which I talk about a lot recently on my main channel, right? I've been talking about that a lot recently. And it's a substantial list of these stocks that are, usually known as safety stocks. Let me pull up the safety stocks watch list. Let's see how these stocks are doing here today. I guarantee you a bunch of them are probably down again, okay? Because these safety freaking stocks just seem like they go down every freaking day. It doesn't matter if the market's up, down, all around. Let's see. Safety stocks. There's the safety stocks. Look at this, okay? Look at these guys. Kraft Heinz, Monster, another 4% hit here today. Look at that drop in Monster. Oh my gosh, it's right off a cliff. Campbell's flipping flapjack and soup. Look at that baby. Holy smokes. PepsiCo. Are we talking jam or are we talking jelly? If you watch the main channel, you know that one, right? Look at that. Right off a cliff. Kellanova. Right off a cliff. Dollar General is now down. Oh my gosh, what is this year to date looking like? Almost 59% Dollar General's down this year now. General Mills, look at the drop in General Mills, the General. Clorox, look at that drop in Clorox. I mean, gosh, $166 back on August 3rd. It's $120 today, folks, okay? So I think these are the sorts of things that are also getting people to re-engage in the market because they're seeing some of the most famous stocks in the stock market that are usually known as safety stocks dropping off a cliff, and that gets a lot of people off their butts and say, you know what, I'm gonna go buy some stocks today.
What happened that was the pullback in equities entirely related to the jump in yields in the Treasury market?
We think a lot of it was. Plus, what we learned coming out of that last Fed meeting and kind of that more hawkish rhetoric. I think people are still trying to grapple with the probability of a soft landing, but it does seem like the market, by and large, has come around to that. So to us, especially given that a lot of that pullback was driven by valuations, it seems to have been a transmission mechanism from that rise in rates.
How does the market just look past everything that's happening, not only in Israel, but the continued war in Ukraine?
Look, we have been doing a lot of work on this, and for us, it's all about isolating the actual economic impact of the conflict. And we do think this could potentially have implications for energy markets. Maybe it puts a floor under oil, it increases the upside risks, but zooming out and kind of thinking through the implications for the domestic U.S. economy and the global economy at large, we don't necessarily think that it's going to have a sustained impact. And that's something that you've seen from prior geopolitical conflicts throughout history as well.
Hey, Andrew, one of the questions is what really happens with inflation from here? We've gone through a soft patch, but you've got oil prices, as Elise just mentioned, that are picking up potentially. You've got potential wage increases as you continue to see a number of organized labor issues where they say they're walking off unless they get really, really big wages. And that's got to play through to other jobs that aren't union, too. And some of the things that brought inflation down may be rolling over, too. You hear about the UAW with the strikes that are now extending. That's going to push car prices back up.
Yeah, this is a very tight labor market. I think that's probably the number one concern for the FOMC here. Now, we've seen some slower, softer wage growth, but if you look at the Atlanta Fed wage tracker, that's the wage number that a lot of economists focus on, it's still sitting up there above 5%. And if you have 5% wage growth, that's consistent with maybe 4% inflation. And by the way, that's what we're going to see in the numbers today. We should see inflation that's coming in 3.6% on the headline, maybe around 4 on the core. That's still well above target. So I think that there is kind of a...
Wages will be less of an issue in 2024, okay? So why have wages been an issue in 2023? I can tell you exactly why. It's a catch-up game, right? Prices of everything obviously went insane 2021, starting at toward, especially the back half of it, right? And obviously 2022. So 2023 has been the year of wages catching up, right? Wages catching up to the realities of what we've been facing with inflation, right? And so what I'm looking at is 2024. Obviously, when it comes to prices of things, as far as the rate of increase, it's not going to be very much of a problem. It's going to be lower numbers. We should eventually get in the 2s, right? And wages will still play a little bit of catch up in 24, but it's going to be much less than 2023. And especially if you're looking at a little bit of a weaker jobs market, which is definitely a potential for 2024 versus 2023, right? I think that matters significantly. And so, the whole wage issue, I guess we can call it, and wage price spiral is starting, in my opinion, coming to an end in 2024. And by 2025, it's not even going to be a thing.
Little bit of a relief here with this soft patch in the inflation data, but to your point, we have a lot of upside risks that are coming up.
What do you hear from your clients, Elise? How are they feeling about things?
I think the biggest question people are still grappling with is whether or not it's worth taking additional risk to pick up a few extra percentage points when cash is giving you such compelling yields. But folks are still coming around to the fact that, these elevated yields won't last forever. Reinvestment risk likely is here on the short end of the curve, but people are grappling with whether or not it makes sense to go all the way out on the risk spectrum into something like equities, or if they can reach their goals, sticking to something like core bonds. So we're working through it, but it does seem like sentiment is improving. And our data showed us that last week, our clients were net buyers on a brokerage basis within equity markets.
What would change your mind about the idea that the S&P is going to hit a new high by the middle of next year?
I think the ongoing conversation around, even if inflation continues to cool, as real rates stay positive and get increasingly positive, whether or not that's going to shift the narrative around the probability of a soft landing.
Is your expectation for where equities land tied to the idea that rates will be cut by the middle of next year, that they'll come down?
Not so predicated on that. Valuations could help us a little bit as they've come down, but for us, it's entirely going to be driven by earnings upside. So it's really the consumer that we're watching closely and macroeconomic conditions on the whole to get us to those all-time highs by middle of next year.
Yeah, the beautiful thing about a lot of these safety stocks, a lot of these dividend stocks dropping so significantly here recently, okay, this is so freaking beautiful, is those are the same exact stocks that hold up very well in a recessionary environment. Doesn't mean they won't fall at all, but those ones, let's just call it, at the end of the day, people are still going to buy stuff from dollar stores, and people are still going to buy, you could say, if you're in a recession, more people are going to buy stuff from dollar stores, and they're still going to buy ketchup, and they're still going to buy soda and all this stuff, right? And so for those companies, they're set up in a great position here, because if you were to have some sort of recession come down the road, 2024, 2025, whatever, right? What's the Fed going to do? The Fed's going to drop rates down to 0. We do know that, right? That's what the Fed does. Anytime we get into a tough economic situation, you start seeing job losses, the Fed cuts rates to nothing, right? If the Fed cuts rates to nothing, guess what ends up happening? Well, suddenly you can't get yield in treasuries, right? Or very minimal yield. Suddenly you can't get that 5%, 4% at a savings account or a CD account. And so suddenly people start looking for dividend stocks, right? So I think that's why some, let's call it a little more advanced folks are starting to look at some of these stocks as like, oh man, this is a tremendous opportunity. While everybody's kind of selling out of these, there's always a buyer on the other side. You got to keep that in mind. Somebody's buying Monster stock today, right? Somebody's buying Dollar General today. Somebody's buying Dollar Tree today. All these stocks getting killed. Somebody's on the other side of that. And you got to ask yourself, who is on the other side of that, right? In my opinion, it's somebody that's maybe a little more sophisticated that says, I think everybody's going to come back here next year. And I'm going to get ahead of that. So that's just my opinion.
See where this ends and what it means for the global economy.
Yes, it's hard, and you have to think about scenarios. I would say the baseline scenario is one in which Israel occupies Gaza. Is going to get ugly, but the conflict remains contained to there. And therefore, the markets so far are essentially pricing this one as being the baseline. That's why oil prices have not done very much, because there is not really a threat to the supply of oil in the Gulf. There was a little bit of a risk off with impacts on bond yields and on gold and so on. But even markets, equity markets have recovered because there are other economic views, like maybe the Fed staying on hold rather than hiking again, that are positive. But of course, there is a downside scenario in which Israel tried to destroy Hamas. Iran, that is a major backer of Hamas, decides to unleash Hezbollah in Lebanon, and then you have a second front in Lebanon, maybe a third one in the West Bank. And at that point, Israel will have to attack Iran. If that were to be the case, of course, then the supply of oil from the Gulf gets, disrupted, and then you could have a spike in oil prices, and then the economic impact will be huge. And in 73, we had the Yom Kippur War. In 79, we had the Iranian Revolution. There was an oil shock that then led to stagflation all over the world. But it's not the baseline scenario, but it's a risk.
But it's a risk. I don't know the probability of that risk, or whether we shouldn't even be talking about probabilities. Are we talking 10%, 30%, or do we just not know?
The honest answer, we don't know. Different people may have different assessment. I would say that certainly the baseline probably will be at least a 2/3 probability that the conflict remains contained to Gaza. Whether then it's a 20 or 30 or 35% probability of something escalating, the honest answer is nobody knows exactly. But the market seems to be discounting the possibility of a massive conflict throughout the Middle East for now.
But if oil goes to even 120 or 130, let's say, how problematic is that for central banks and the world economy?
Well, it's problematic in two ways, because higher oil prices implies that most economies go into a slowdown of growth or a recession, and then there's a rise in inflation. It's a stagflationary shock, and then becomes a huge dilemma for central banks, because either there's raise rates to try to fight that inflation, and then you have a more severe economic contraction, or if you decide that you care more about growth, and then you don't raise rates, then you have a de-anchoring of inflation expectation, like it happened in the 70s. So whenever you have a negative supply shock, this stagflationary then becomes a real dilemma.
So you know what I would do if I was T-Man? Because obviously it's likely going to be T-Man versus B-Man in the presidential election, right? So you know what I would do if I was him? I think this would be genius. One of my many things I would campaign on is I'm going to give, basically I'm going to increase oil production substantially in my 4 years in office. And that way we bring down oil price, right? And that way we bring down gas price at the pump, because we know how many people are concerned about gas price at the pump, right? And obviously everybody's seen all the subsidies and everything that's going on from the other side in regards to like EVs and charging networks and everything like that. So if you have somebody that campaigns on the other side, oh my gosh, would people get behind that like insane? Because basically the oil companies, they don't want to drill. They in the United States for the most part. They want to just do what they got going on, but they don't really want to start new refining facilities. They don't really want to, open up a ton more new wells because, if anything, they're incentivized to keep prices in a more elevated place. So, and you don't even have to make it a reality. At the end of the day, like politicians, you got to just be a politician, right? And say certain things. And also that would freak out the oil market in a huge way. If just the fear of that. Like, oh, we're going to use, tens of billions of dollars of federal money to drill for more oil, refine more oil. That would freak out the oil markets. I can guarantee you that, because T-Man's got a very good probability of winning the election come next year. And so I'm just telling you, like, woo, you got to remember the oil market moves a lot on sentiment. And if you have a politician that's saying we're going to use federal money to start drilling like crazy, oh man, would that cause everybody to freak out in a massive way? So anyways, yeah, it just came to my mind.
Central banks, and we don't know how they're going to be answering to this shock.
It's also like there's just a global sadness, right? A lot of people are speaking out. I don't know whether this impacts spending.
I think that actually it impacts, first of all, business confidence, especially in Europe where economic activity is effectively contracting, has been contracting for a number of quarters. I would say that if you are any business, there's an option value of waiting. If you have to decide how many more workers to hire, where to do more capex. And there's been a slowdown, for example, in employment growth in the Eurozone so far. The economic contraction on the GDP production side has been more severe. So this could be actually a tipping point where firms decide, I have no idea whether this conflict is going to spread or not. Let me wait and see. I'm not going to hire anymore. I'm going to stop some of the capex. And that could become self-fulfilling and imply that the Eurozone is already borderline into recession. Same thing with the UK going to an actual recession. So even the probability of something bad happening affects through uncertainty decisions of the business sector and maybe not consumer. Consumer may slow down consumption as well.
Nouriel, how critical are the next couple of days or weeks? So if we have boots on the ground in Gaza from Israel, is this an escalation point that could actually happen quite quickly?
Well, I think that most people expect that Israel at this point has no choice but go.
Folks, that is extremely important what you're seeing right there in front of you, okay? IMF cut UK growth forecast to 0.6%. When you start talking about those sorts of numbers, folks, that is flirting with recession. No doubt about it. That is flirting with recession. That is, you got to start to worry.
To Gaza and get rid of Hamas forever. And they didn't do it in the past. It's going to be painful. It's going to be ugly.
Be a strong escalation, right?
It really an escalation, but I believe that the markets are already pricing in that Israel has no choice but going to Gaza. The question is going to be, once they go into Gaza, whether then skirmishes that are occurring in the north become more severe, whether Hezbollah in Israel start a real war, and therefore there'll be a hand of Iran directly in that happening, and then the conflict will become regional as opposed to being limited to Gaza. Then the markets are pricing in that something ugly is going to happen in Gaza, unfortunately, and there's no other choice. So they're not worried as much about that, but about whether there's going to be an escalation.
Yeah, we'll see. We'll see what happens with that. We have had, Middle East has not really been a big subject in terms of volatility there for, quite a bit of time. I think the market's going to have to get used to potential problems in that region again, and it's just something you got to work through. There was problems in the Middle East for a long time, right? All right, next one up here, AWS CEO. This one I'm looking super forward to as an Amazon shareholder and what he has to say in regards to Amazon's growth and everything going on here.
Is HQ2 with the CEO of AWS. Hi, Eamon.
Hey, Carl, that's right. We are in Northern Virginia. We are at Amazon's brand new HQ2 building. This facility just opened in May. It is gorgeous. I can tell you, we've had a chance to walk around, and I'm here with Adam Selipsky, the CEO of AWS. And Adam, thank you so much for having us.
Thanks so much for coming, and it's a real pleasure. It's exciting to be here at HQ2, and thanks for joining us.
You don't get the chance to get to D.C. all that often, I guess, but this is a fantastic facility you guys have built.
Well, I do come through pretty frequently. We have so much activity here in this whole area, in D.C. and Virginia and of course, Maryland, and lots of employees, lots of data centers, lots of activity.
I wanted to talk to you because I had the opportunity a couple weeks ago to talk to Elon Musk about the future of AI. And this is the subject that's just on everybody's mind right now. What is AI going to do to my industry in particular, whatever industry you happen to be in? You guys are in the AI business in a very big way. I noted you just did a huge deal, $4 billion investment in Anthropic, I guess last month. And there's an ongoing revolution happening behind the scenes that a lot of us on the outside can't see. So I wanted to get your thoughts too. Elon told me he thinks, the future of civilization is at stake with AI. I mean, I'm a little bit more concerned myself with just the future of the workforce and employment and how that's going to shake out. But I wonder, as you guys focus on AI, just start with internally, how is it changing your business already?
Well, AI, generative AI is going to, I think, pretty much change every application inside of companies, every application that consumers interact with. It is a profound technological change that we're still at the very beginning of. People think we're way into it. It's day 0.1. But I think there is a lot of change coming. And inside of Amazon, first and foremost, we are building generative AI powered capabilities for our customers. We are completely customer obsessed, and we're in AWS. We're building, we're designing our own custom chips that go into compute the companies will use. We're bringing access to all of the most important and powerful large language models that companies want to use. We're building applications that folks like developers and other professionals will be able to use for lots and lots of everyday work tasks. So we're mainly focused on our customers in this area.
So before we get to the future of civilization itself, maybe talk about the future of the workforce. How are you seeing changes already inside Amazon and inside AWS as you roll out these new technologies? Are you seeing shifts in employment, where you need numbers of people, how you deploy those people?
Well, we are, Amazon has been doing AI, I would say, for probably 25 years since we started personalizing the Amazon website back in 1998. So we have many, many thousands of professionals who have been doing AI already, and we're pivoting many of those, as you might expect, to building generative AI capabilities for our customers. I do think that any big technological change will bring changes in the skills that are needed. The internet changed a lot of skills that were needed. I would argue the internet has been massively beneficial for the economy, for productivity. It's created, I don't even know how many millions or hundreds of millions of jobs around the world. And I think generative AI will be the same. So I think there will need to be reskilling. There will need to be retraining. We are already helping people reskill for AI jobs and have produced a curriculum and content to help people with those skills. And I think that'll be a huge opportunity for many, many people for years to come.
Interesting. Yeah, I didn't get enough there. I was hoping for a lot more. By the way, I'm curious to check out Amazon's stock price, because did you guys see it was nicely green there when the interview was done a couple hours ago, but I'm guessing it's probably down based upon the market action here. Let's see, big tech. Yeah, it looks like a lot of Red Dead Redemption out there. Yeah, Amazon. Let's see. Oh yeah, it was a good day for Amazon, and then it was not a good day anymore. Okay, but yeah, that seems like pretty much big tech across the board got slammed. But yeah, man, I would have liked to see more in that interview. I didn't. That was not enough. That was not sufficient for me as an Amazon shareholder. Let's just put it that way. So appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed to the channel. If you want to say hello to me, say hello to me on Instagram. I post a ton of Instagram stories, news that's going on, viewpoints, different things like that. That will be pinned comment down there. Much love and have a great day.